announcement before we get into our talk. The announcement today is that we are putting out a call for volunteers to join the IRMAC board. We're looking to fill three board positions, the vice president, the membership director, and the publicity director. We're also welcoming folks who are interested in joining the board in a smaller capacity as members at large. You can visit irmac.ca/volunteer for more information. And if you're interested, you can reach out to our president by emailing president@irmac.ca. Before we begin, I would like to thank our sponsors for making this session possible. Our thanks to First San Francisco Partners, whose sponsorship helps us provide the technology that allows us to hold these webinars. And our thanks also to InfoSet, whose support helps IRMAC to continue to do all the stuff that we do. So today's talk, I'm very pleased that we're going to welcome Ian Tam from Morningstar to talk about the importance of data quality in equities. Before I pass it along, I do want to say that today I'm also joined by two other IRMAC board members, by Nick, who you will see in the chat. Nick is our online content director and provides the technical support that runs these webinars, and will be monitoring the YouTube chat for your questions if you have questions during the presentation today, and we'll be relaying them to our fantastic guest. And I'm also joined by Deborah, our program director. Deborah is going to take a moment to tell you a bit about our speaker. Take it away, Deborah.
Thanks. Thanks, Eden. I'm Deborah Henderson, and I'm going to introduce Ian, our speaker today, and give you an overview of what he'll be talking about. I'll also be monitoring and facilitating the session today. All right, so what you see on the screen right now is our IRMAC website, and underneath the events pull down, you have our particular session today. So if you're ever interested in looking at our events, either past or present, and I'll back up to show you what that looks like, you can go back and see where look at the detail and click on the link for our YouTube session, which will be permanently published on our YouTube channel, which is IRMAC.org, where you are now. So today's session, importance of data quality in equities, and we're talking about financial assets management, is not as commoditized as you might think. That's our session for today, and Ian is a CFA, Director of Investment Research for Morningstar Canada, and is a wholly owned subsidiary of Morningstar. Prior to his current role, Ian was a Sales Director for CPMS, Morningstar's quantitative screening and backtesting platform for equities. Before joining Morningstar in 2014, Tam worked for Thomson Reuters Financial and Risk Division, where he helped retain and grow business with buy-side clients and sell-side equity research firms. Tam holds a Bachelor of Applied Science in Mechanical Engineering from the University of Waterloo and holds a Chartered Financial Analyst designation. In his spare time, he's an avid yogi and raising a rambunctious new puppy. Love that. So on to our session today. Across the plethora of data now available to investors, fundamental information from publicly traded companies is among the most widely available and is often viewed as the most standardized. It might be assumed because of GAAP and IFRS standards and their utilization, that this data is ready to use by investment professionals. But when reported earnings per share not really when is reported earnings per share not really representative of the company's economic earnings? And how does this impact an investment strategy? What other derived fundamental measures can be affected by one-time adjustments reported to the issuer? Join us for an overview around some of the most common issues for Canadian issuers All right. So with no more ado, Ian, would you like to share your screen and get underway?
Yeah, great. Thank you very much. I appreciate the intro, and Eden and Nick as well. Thanks everyone for having me. It's a pleasure to present to IRMAC here in Canada. So yeah, like Deb said, what I'm going to be talking about today is really data quality in equities, and specifically Canadian equities. Like Deb mentioned, equity information is very readily available. Any sort of public issuer is going to have fairly standardized filings. I should say we're short of having machine readable filings here in Canada on CDAR, but we're making strides toward that direction, making it easier for data professionals like yourselves to collect that information. But my point in today's presentation is really that when you're working with investment professionals, particularly portfolio managers and those that are making decisions and buying and selling stocks, is that data is not easily consumed in the way that it's presented directly from these companies or from these issuers. That's really the whole point that I'm trying to take across today. That being said, my name is Ian. I'm the Director of Investment Research for Morningstar Canada. And my role here is really just to try to evangelize Morningstar's thought leadership across multiple market participants, including individual investors like you and I, all the way up to institutional portfolio managers and pension funds, as well as some highlights in the financial media. So it's great to be here, like I said earlier. So a few points on the agenda today. I'll talk a little bit about Morningstar. Many people know Morningstar for one thing. I'll talk about some of the other things that we do, just for your information as data professionals. We'll talk about the public equity landscape in Canada at a pretty high level, some of the fallacies of the way that our market is structured. We'll talk about what's reported today by financial issuers or public issuers, and pretty much why it's not sufficient in the way that it's being presented. We'll certainly talk about some common adjustments that affect earnings per share, aka the lifeblood of a company, particularly in Canada. And the crux of the presentation is, how does this impact investors? If I'm going to be buying and selling in stock, what data should I be relying on? Or at least, how can I understand what adjustments need to be made to make that information useful in analyzing a company or integrating that information into an investment strategy? So we'll talk about some fundamental metrics like key value ratios, growth ratios, some sentiment indicators, and really I'll take you through some worked examples as well through some of Morningstar's analytics, just to really help illustrate the point. There's many ways that we can do this. The platform that I'll be using really has a quantitative approach to doing stock analysis, which is frankly unbiased, and I think it's a very appropriate way to illustrate the impact of data quality, specifically in Canadian equities. So a little bit about Morningstar. This is the obligatory corporate slide, but certainly happy to let everyone know that Morningstar has about just shy of 7,000 employees. We actually operate in, I think, over 30 countries now, and our goal, our primary mission is really, as it says at the top, to empower investor success. So everything that Morningstar does through its data collection, development of analytics and platform, and frankly acquisition of entire companies, is really for one reason. It's to help investors like you and I reach our financial goals or make better financial decisions, at least in terms of how we invest our money. Across the globe, we serve multiple demographics, financial advisors, asset managers. In fact, we have a very large, in the US, we have a large asset management entity, a legal entity in the US, Morningstar Investment Management, that primarily helps with corporate pensions. And of course, through our retail websites like Morningstar.ca, Morningstar.com, etc., we serve individual investors as well. So it's certainly Morningstar is known in Canada, I think, for one thing, and this slide is really to demonstrate really the breadth of where we've gone since then. So the thing that we've kind of been known for in Canada is really mutual funds and ETF ratings. So very often you'll see in marketing material from fund companies, oh, this fund is a 5-star fund from Morningstar, or it's a gold-rated fund. That's really where Morningstar built its brand from back in, I think, 1984, 1985. In Chicago, but since then we've actually grown quite a bit. bit. Like I said, we've acquired a number of different companies over the years. Some more recent acquisitions include PitchBook, which is a global private equity database, DBRS, which if you're in Toronto, you know the large building over there on Queen Street. It is the 4th largest credit ratings agency in the world, now part of the Morningstar family. Very relevant in Canada and globally. We've recently acquired Sustainalytics, which actually has a very large footprint in Canada. It was formerly headed by Michael Janci. Many of you might recognize that name from the Janci Social Index. So the area of ESG, environmental social governance, and sustainable investing, of course, is showing explosive growth here in Canada, very prevalent in Europe as well. We're happy to have Sustainalytics as part of the Morningstar family. And then finally, as it relates to the recent regulatory changes around advisors, we also house Phenometrica, which is a database, an academically validated database around financial planning and risk tolerance questionnaires. So yeah, just to give you a kind of a broad overview of what Morningstar does, we are certainly more than just mutual fund ratings. We span a pretty big piece of what we feel is important for the end investor. So let's talk about the Canadian equity markets for a second. And what I could say to kick off is, when comparing our market to the US, the main statement is that we are far less efficient. But in terms of trading volumes, obviously, you know, we're seeing much thinner volumes in Canada versus the US. News coverage is thinner. Analyst coverage as well from street analysts is not quite as robust as in the US. And we're very top heavy. So a large market cap stock in Canada might be considered a medium size or a mid cap stock in the US, at least according to Morningstar Style Box methodology. So all in all, we're far less efficient than the US, and that's actually quite an advantage for an investor or a portfolio manager, because it allows them to exploit those inefficiencies to generate alpha in their investment strategy. Definitely more opportunity to be had to be able to beat our benchmark in Canada, if we call that benchmark the TSX Composite, for example. And we'll talk about how that maybe how data quality can help with that everlasting search for alpha. So what I thought I'd do is just kind of map out, just give you a visual of how the public equity market is structured in Canada. And like I said before, it's very, very top heavy. By Morningstar's count in our database, we have about 3,400 publicly listed equities in Canada. Of those, about 2,800 of them are actually domiciled or headquartered here in Canada and doing business primarily in Canada. You can see on the chart here, all I've done is I've ordered the companies from biggest to smallest by market cap. And the point here is to show you how quickly that market cap graph drops off. So you can see number one, the biggest market cap stock in Canada right now happens to be Shopify, a recent rise to the top, and then followed by RBC, and the third dot I think there is TD Bank. But you can see that as you go to the right, the market cap drops significantly. What this tells you is, like I said, it's top heavy, and because news flow and analyst coverage tends to tilt towards bigger companies, what that leaves is a large number of companies or a large number of stocks that are undercovered and typically don't give you a lot of information, which increases our reliance on what these public issuers are actually filing in their regulatory filings. So yeah, there's lots of information in that kind of this section of the chart. I don't know if you can see my mouse here, but anything outside of the top 50 or 60 stocks, you're going to see a bit of a sparsity of information, or at least sparsity of good quality information for the companies that are being covered. The second comment I would make about Canada is that not only the economy, but actually our selection of stocks is concentrated in a few sectors. This chart or this table might look a little bit different than you're used to seeing, because you typically see this broken out just for the TSX Composite, which is about 240 companies. This table actually looks at all 2,800 companies that I was talking about earlier. So of course, financial services, if you were to add up all the market caps of the financial services stocks in Canada, this would be the the figure here, and that's about 277 companies. The average market cap in that space is about 3.8 billion. If you take that as a percentage of the total, it's about 28%. That's followed by basic materials, industrials, and so forth. I just want to make sure that you notice that there's a stark difference. There are a large number of basic material companies, metals and mining type companies with smaller average market cap. So there's a large chunk of very small companies that represent basic materials. So again, very focused on a few sectors, which is reflective of our economy. The third thing I should mention about our market here in Canada is that the earnings season is very clumped together, I guess, in a way, and it's very cyclical. So as you know, fundamental information like earnings per share, as an example, that doesn't change really every day. It changes when the company has to, in a regulated way, report their latest financial statements, and that happens in very distinct seasons. You can see on the chart, this is kind of when these companies report. And the reason this is important as an investment professional and as a person managing data for investment professionals, the timing of getting good quality data is of utmost importance. For every day that passes that this information goes stale, other market participants are pricing that into the price of the stock, which leaves you as a portfolio manager kind of in dust. So having very timely, accurate information in equities in Canada is of utmost importance, and it makes it all the more harder because these reporting seasons are so close together, or so clumpy, four times in the year, which is a bit more I guess concentrated than what we see in the U.S., and it's a bit more spread out based on
There's a question for you, Ian.
Mm.
They say that after the end of a financial period, a quarter, or at the end of year, the further away you get from that reporting period, the better the data quality for that period, because there's straggler information that comes in after the reporting. So how does that play against needing to have the data right away? And,
absolutely.
going stale.
Yeah, I would absolutely agree to that. The point is that you can't act on that data. The quality may go up, and I totally agree with that statement. But your capacity to act on that information diminishes quickly. And maybe a good way to summarize, which we'll talk about later, is through the use of like earnings surprise, right? So if a company misses or beats earnings, the day after you can see there's a very quick reflection in the stock price as the market prices in that earnings beat or earnings miss. But for every day that passes afterwards, you can see the stock price kind of normalizes or levels out.
I see. So it's based on the available data information at the time, regardless of its quality, because you need to act on it.
Absolutely.
As opposed to the company itself, which may feel more confident, a month after the end of a quarter with what its figures actually say.
Absolutely. And I would say that, public companies tend to restate earnings over time as well. But you can only act on what you know at a given point in time. As a portfolio manager, you have to make that decision. So it's of utmost importance that you get to that quality data as soon as possible, so that your portfolio manager can pull the right triggers.
I mean, what are the regulations here in Canada and the U.S. for getting that end of quarter report out? I mean, is there a regulatory limit to how many days after the end of the quarter you need to publish? Because I was involved with a company that could barely publish the end of quarter before the next quarter was due.
Yeah, there is actually. There is. I don't know the exact time frame. I should probably have to check in on that. So I don't have an immediate answer for you. There was a proposal from the Task Force for Modernization of Ontario's Capital Markets. That was a kind of a large paper that was put out. And I think one of the things that they were thinking of to reduce burden for smaller issuers, like probably like the company you're talking about, Deb, is to maybe reduce the frequency at which financials were required to be reported. So instead of so for companies under a certain market cap, maybe only report twice a year as opposed to 4 times a year. That was what was proposed. Morningstar actually commented on that letter to the task force and to the OSC as well. We don't agree with that approach because what it does is might encourage, well, first of all, the lack of the less transparency there is, the less efficient I think capital markets are. So despite having some burden for the company to have to create these documents, and it might it might influence investors to try to find information that's not publicly available, which is sometimes misleading. So that was a proposal. We're not sure which way it's going to go. Morningstar's view is the more transparent you can be, the better.
Right, and of course, timing of the data is a big element to data quality, particularly in assets.
In asset management, yeah. Yes, absolutely. I don't want it to sound like too much of a sales pitch, but yeah, it's that's something that Morningstar certainly takes into account, particularly for Canadian equities, because there are so many inefficiencies, we typically have a 24-hour time frame in which we have to read the financial reports and then also produce a normalized version of them for consumption into our products.
Wow. Okay.
Yeah. So the reporting standards in Canada are, it's IFRS is the standard. There's also a Canadian GAAP, neither of which are really perfect for the purposes of investor. And if you want to go into the weeds a little bit, I'll pull up two very specific examples. If you look at an energy company, doesn't matter which one you look at, I'm going to use Suncor because it's large. Energy producers typically have obviously large exposure to the price of crude oil. And in a way to hedge that exposure, they're going to buy and sell futures contracts or financial instruments to offset their risk or offset their exposure to oil prices. Now, through IFRS reporting standards, these same companies have the ability, they've actually mandated to market those financial instruments. So if the price of your futures contract goes down by 10%, you're going to record in that quarter, you lost 10% or you gained 10% or whatnot in your statement of earnings that quarter. Now that's very convoluted because it detracts from the actual economic earnings that you're deriving as an energy producer. You're not in the business of buying and selling financial instruments. You're in the business of producing energy. So having these mark-to-market adjustments on your financials tends to distort the actual earnings of the company. So that's one example where actually reporting to the standard is detrimental to actually illustrating what your company's actually doing in terms of earnings. Another example would be the opposite example is where you're looking at perhaps a financial institution, maybe a bank that sells a large building. Now, banks are typically not in the business of buying and selling buildings, but they are in the business of buying and selling financial instruments. So in the case where there's a gain or loss of disposal, gain or loss based on a disposal of an asset like land or a building, that's a one-time effect. A large bank is typically not going to be disposing of large buildings every single quarter, and that's another area where reporting standards will kind of distort the true economic earnings of a company.
I'm sorry to jump in for a second. Ian, what exactly does GAAP stand for again?
Oh, sorry. Generally accepted accounting principles. So it's a there's a U.S. GAAP is kind of the main standard. There's a Canadian version of that. And IFRS
Perfect,
is.
thank you.
Yep, no problem. Sorry, let me just open up my chat here so I can see. Okay, yeah, generally accepted accounting principles. It's a standard of reporting financial statements. This is a kind of a dated article from a few years ago, but you can see that basically what the article says is that there are a larger number of companies that are reporting these non-GAAP measures or non-standardized calculations or adjustments, and it's an issue that we have to, as data custodians, we have to keep an eye on this type of thing.
So when you say that they're generally accepted principles, they are not written into law, because we see, a pervasive cultural shift in the world of ignoring cultural norms, and that have served us well for a while. So how embedded are GAAP into the law?
That's a great question. I don't have a great answer for you, but I know that the two standards are both frameworks through which companies can report their financial statements. The two standards are slightly different. And I believe IFRS is the main standard that's required in Canada, or at least we're pushing toward that direction.
Okay, thank you.
Yeah, sorry, I couldn't give you a more detailed answer there.
No worries.
So what do investors actually, if I'm a portfolio manager, what is it that I actually care about? If you've all seen financial statements before, these are the three main ones. Now, I'm not saying that most of these aren't important. I think each of them are in their own right, but really the essence or the lifeblood of a company, like I said earlier, is the earnings per share, because that earnings per share drives a large number of fundamental financial metrics that portfolio managers, investors care about. There's two versions of that. There's earnings per share, and then there's the adjusted earnings per share, which is after you take into account discontinued operations and spin-offs and the like. And that therein is the crux of what is the most important. And the reason for that is because earnings per share drives a whole bunch of different financial metrics. So price for value-oriented investors, you're looking at things like price to earnings ratio. So if your earnings per share is incorrect or is convoluted because of the way the company reported, your PE ratio is going to look all off. For a quality investor, profitability or quality metrics like return on invested capital, return on total assets, return on equity, these are all very important measures that basically define how profitable a company is. In fact, Morningstar's own approach to valuing a company, a public company, is heavily reliant on a company's ability to produce return on invested capital above their cost of capital over time. For short-term investors, things like earnings momentum and earnings surprise that often are they drive the stock price in short bursts are super important. And even for dividend investors, dividend investing is a very popular approach in Canada, especially for retail investors. And one of the ways that you can kind of get a hint of how sustainable a dividend is going to be in the future is to look at a payout ratio. And that's basically what percentage of dividends are being paid out of the earnings. So is the company paying out too much of their earnings in the form of dividends? And there you want to look for a nice conservative or a low payout ratio. And of course, again, if your earnings per share is incorrect, then your payout ratio is going to be incorrect. So you can see that earnings is so crucial because it drives so many different metrics that investors rely on day to day to make decisions. So now we come to the point that what can we do? So I think you can kind of get from context that to be able to properly use earnings per share in an investment strategy, you have to remove or add adjustments to essentially remove the noise of these unusual accounting items from the company's performance. And what that does is it ends up smoothing out a company's earnings per share over time or over a given period, and it produces a much more accurate measure of the firm's actual economic earnings or earnings from its core operations. And that's the essence of normalizing earnings, and it's something that Morningstar has been doing for a long time now. Now, some very typical adjustments that we look at are things like restructuring charges. So in terms of where you're spinning off or you're buying a new company, there's going to be those types of things there. Unrealized financial gains and losses. So that mark to market of financial instruments was an example of that. Gains and losses on disposal of assets. That sale of a building, for example, was a good one. Write-offs, write-downs, and litigation charges. These are all one-time type items that don't happen every single quarter. And when not saying you shouldn't know about them, but when you reflect those in a company's earnings per share, it can often distort that, and it can distort a number of different financial ratios. So how can you do this as a data manager? You can think of three ways. One is you can rely on the company, because in many cases the company does provide an adjusted earnings per share figure, and it's relatively easy to capture. And they often produce those adjustments, and they don't necessarily need to write about them in their notes or discussion. The cons of that is that not all companies provide adjusted earnings per share. It's not required, and like I said earlier, it's heavily weighted towards larger companies with resources available to them to produce these documents, typically are more detailed in their adjustments. Whereas smaller companies, again, remember the smaller companies is where I think at least alpha can be generated. They may not have the resources to put those adjustments in place. Secondly, not all adjustments are governed by accounting rules, and that gives the potential for the company to spin their adjustments in a positive way. And this is a stat from, I think, 2016, but 80% of the adjustments that we found from the company tended to be in the positive direction for obvious reasons, right? To make the stock look a bit more attractive than perhaps it is in reality. The second way you can do this is by formula. So if you know that there's going to be a bunch of common adjustments that you see across different industries, why not build a formula and do it yourself? And that's a nice, easy way to do it. And it assures that you look at each company in a standardized way. The cons is in the quant world, we say garbage in, garbage out. So if you have poor quality assumptions on what the adjustments are going to be, you're going to get poor quality data coming out of it. And most companies do not hold adjustments in distinct line items in their financials. So it makes it very difficult for a formula to pick that up. And no methodology is going to be able to handle every situations. Adjustments by their very nature are not standardized, and hence it's very difficult to do that accurately over time. And finally, the most expensive way you can do this is, of course, hire an analyst team. And this is really what sell-side analysts do for the most part. They're looking at adjustments as well to get a true economic reflection of what the company is doing in their earnings per share. It's an unbiased information which takes into account different types of inputs as well to have an idea of what's happening with the company. And in our opinion, it's the most accurate, and this is how Morningstar does it. And the cons of this, of course, is the most expensive. So hiring a highly skilled set of data analysts, as we all know, is fairly expensive and requires some training. So these are the three ways we can approach it. Morningstar does the last one, at least for Canadian equities, and we think it certainly has worked in our favor. So here's a couple of just making sure I'm speaking a little quicker now, but just to make sure I get through my content. Here's an example of this, again, it's a bit dated. I didn't want to pick on any one company in particular, but this is a Cameco for Q3 of 2018. They reported adjusted, so in their opinion, an adjusted net earnings per share of 4 cents. That's $15 million of earnings divided by their shareholder equity. But if you actually looked through their one line adjustments, there was actually a reversal of a tax provision related to a CRA dispute in that same quarter, and that amounted to $61 million. That's not something that they actually reflected, even though they reported it as a separate line item, a separate adjustment. That's not something that they accounted for in their reported or in their adjusted earnings per share, and that can make a pretty large difference, as you'll see in a few seconds. And this is not an issue that we see just in Canada. Again, this is a bit of a dated example, but I thought I'd choose a very large company, international IBM. This was Q1 of 2012. They reported 11 cents diluted earnings per share. Sorry, they reported $2.61, my apologies, with an adjustment of 11 cents. What they didn't report, though, that there was another one-time adjustment due to a tax change or tax regime change in their exposure to Latin America, which resulted in a 15-cent adjustment that we made, but IBM did not make. And that difference, 15 cents out of $2.78, is a difference of 5.4%. And that's it. That may not sound like a lot, but that's enough for the company to either beat or miss earnings expectations. You can usually see that within that percentile range. So these are very real issues that we're dealing with. I chose a couple of dated examples, but these types of things happen every day, every reporting season, as our analysts will tell you. So again, very important that we pay attention to this type of thing. So let's see this thing in action. So what can we actually do about this? And let's illustrate the impact of having normalized versus not normalized earnings in the context of an investment strategy. Let me see if I can. Okay. So I'm going to pull up one of Morningstar's platforms. The platform's called Morningstar CPMS. CPMS stands for Computerized Portfolio Management Services, a company that was founded in 1984 and purchased by Morningstar in 2009. And in its essence, it's essentially a quantitative screening and backtesting tool focused primarily on North American equity. So I just want to maybe pull up a number of stocks in Canada. This is all based on yesterday's close data, or the latest yesterday's close, or the latest reported by the company. And if you have a look at even a company like Enbridge, if you look at their straight reported net income, it's $3 per share. If you look at the adjustments to that, it actually shows us $2.51. That's a pretty big difference. I mentioned earlier things like earnings momentum. Another way to describe that is year-over-year growth of earnings. That can be affected as well. So an example would be Scotia. If you use unadjusted earnings, showed a year-over-year growth rate of earnings of 2.1%, whereas after you make adjustments, it's actually negative 4.6%. I also have examples of PE ratios as well as return on equity. So in almost all these cases, you'll see that the adjusted version of these financial metrics are going to be very different than the unadjusted or as reported version from the company. To show you the impact of this, I wanted to maybe take you through a back test. That's one of our capabilities in this system. So to run a back test, I'm going to make a few assumptions. So first off, I'm going to look at a universe of stocks. Our Canadian universe of normalized earnings consists of about 700 companies. And what I'm going to do is I'm going to sort those 700 or so companies by one factor. In this case, it's going to be the unadjusted return on equity. And it's going to sort from highest to lowest. I'm also going to look at screening. So I'm going to only include companies with a reasonable market float. So is basically excluding the bottom third of companies in that database by size. So that figures about basically anything that's smaller than $100 million in market float. I'm going to exclude those, and that's the basis of this test. I'm also going to apply some industry or sector screens. I'm only going to include 10 companies for each sector. So to illustrate the impact of adjustments, I'm going to run what we call a single factor or a single variables test. And in essence, what it does is it takes some number of stocks. I've chosen 100, and I'm going to pick 100 stocks from that universe based on the parameters I just showed you. And every quarter, I'm going to reselect a new set of 100 stocks based on ranks to reflect the companies that show the highest return on equity. I'm just going to give a second for this thing to load. Check the screen for chat. There it is. Okay. So this is the result, but I'll run it again once in real time. So I'm going to assume we started with $10 million in cash in February of 1999. And like I said, once a quarter, I'm going to apply a set of rules, which is essentially selling the entire portfolio of 100 stocks and then rebuying the ones with the best quality characteristics, or in this case, the highest return on equities on an unadjusted basis. I'm going to equally weight my stocks, and I'm going to hold no more than 10 stocks per sector. So just going to make this run for you just to kind of give you a description of what's happening. So this is what we call a back test. Our database, this database is what we call a point-in-time database. So when it's making its decisions, it's only basing those decisions on the information that was available at that point in time. So Deb, to your point earlier, it makes although quality of information does get better as time passes, you can't act on that. And that's what this database is supposed to reflect. So if you had bought and sold based on what you knew at the time, this is what would happen. So what's happened here is in February of 99, we purchased 100 stocks, the 100 stocks with the highest ROEs on an unadjusted basis. Every quarter after that, we look at that same 100 stocks. We sell the ones that are no longer in the 100. And we buy a new set, and again, never owning more than 10 stocks per economic sector. So we're essentially
is this daily data?
This it's monthly data, but I'm only applying the rules on a quarterly basis.
Yeah, because it occurs to me that the volume of data that must be stored in order to get this result must be very large.
It is, yeah, it is quite large. Thankfully, storage has gotten a lot cheaper over the last number of years. And in fact, I know that CPMS in its heyday used to mail out, CD-ROMs and floppy disks full of data. I think used to courier out that information. But now, of course, it's all readily available through a regular kind of standard internet
Sure.
connection.
So what granularity does your company overall keep the data? Is it daily, or is it for research purposes, or is it monthly?
It varies based on the type of data. So for market information, we have a tick-by-tick database. For fundamental information, it's typically on a monthly basis. Yeah, but it depends largely on the type of data you're looking at.
Okay, interesting.
So what this shows you is that had you bought the stocks with the highest unadjusted return on equity and just kind of continued to buy those types of stocks over time, in this case over the last 22 years, you would have resulted in an annualized return of 12.4% with a turnover of 94%. And that makes sense because you're buying and selling stocks every single quarter. And that's not bad. That's not bad. 12.4, that's better than TSX by 4.3% as it happens. Now, I'm going to show you the results of that same test, but using adjusted earnings per share or adjusted return on equity. So I'm not going to rerun it again. I'm just going to show you the results. Once it loads up, what it's going to show, it's going to show you a slightly higher annualized return, which is neither here nor there, but it'll also show you a lower turnover. So yeah, there's the slightly higher annualized return and a 20% reduction in turnover, and that's important as a portfolio manager because. Yeah, so what you can see is that when you're looking at normalized earnings or normalized ROE, as you see here, you're smoothing out earnings over time, and what that results in is a reduction in I guess noise in your portfolio. There's less of a probability that you're going to trigger some sort of a buy or sell rule because that information is not being normalized. And that's important for a portfolio manager because typically you don't want to be doing a lot of trading in your portfolio. That increases your cost and it reduces the amount that the investor gets in their pocket. So this is a direct impact of having normalized data. I wanted to show you another, I'm not going to run another example, I'll just show you the results of another example. So this test here looked at the price earnings ratio. So this is just a value focused metric. So if I chose the cheapest stocks based on unadjusted PE ratio, what would that look like over time? And once this loads up, it'll show you the results. So again, not a bad return. This is a very large 100 stock portfolio, which is not reflective of what realistically an investor would hold in real life, but this is just to illustrate the point of the data. So 13.3% return with 150% turnover. And then if I look at the adjusted version of this test using adjusted earnings, again, you're gonna see a slightly higher return and lower turnover. So just wait for this. Apologize for the speed of my computer. It is a lot of data, as you mentioned, Deb, but I'll give it a second. So there you go. So lower turnover. So the real I guess eye opener is once you see the interplay between different factors, because very rarely will an investor choose a stock strictly on ROE or strictly on price earnings ratio. In reality, it's a myriad or a mixture of factors that are going to be important to an investor. And the beauty behind a quantitative approach is that you can really pinpoint how important each factor is. So what I thought I'd do is to basically show you a strategy that I built, and I'll just walk you through it very quickly. So instead of looking at one factor, I'm looking at multiple factors. So and this example is all on an unadjusted basis. So first of all, I'm not picking from all 700 stocks. I'm only picking from stocks that are within the S&P TSX composite. Again, that's about 240 companies in total today. And what I'm doing is I'm putting a 40% emphasis on year-over-year earnings growth, a 40% emphasis on price earnings ratio, and a 20% emphasis on return on equity. So on that basis, I'm going to rank the stocks from best to worst. You can see Interfor Corporation is stock number 1 based on the degree of importance that I'm placing on each of these factors. Then in order to buy a stock, I'm only going to consider the top quartile of that list. And I want the year-over-year earnings to be positive or greater than 1, or greater than 0, sorry. And the ROE to be positive and greater than 0. What I'm also going to do is specify some sell rules. So I'll say if the stocks rank drops below the 35th percentile of my universe, I'm going to sell that stock. If the earnings growth drops to negative 10% or worse, or in other words, if earnings shrink by 10% or more over a year, that's a trigger for me to sell the stock. Or if return on equity becomes negative, I'm going to sell the stock. I'm going to run this as a 25 stock portfolio, never holding more than 5 stocks per sector. So this is an example of an actual, I guess, a bit more realistic approach to buying a portfolio of companies. I'm not going to run the test, but I'll show you the results once again. On an unadjusted basis, that strategy over 21 years would have returned me about 7.3% annualized. Again, you're showing a pretty high turnover. So that for me as a fundamental portfolio manager, that probably not acceptable for me. 121% seems a little high. If I were to run that same strategy using adjusted factors, adjusted earnings per share and factors, it looks a lot different. So we're looking at a 9.9% return annualized over time, which beats the index by 1.8%, and in some ways a more reasonable turnover. So 91% turnover, which is still pretty high, but again, we do have some momentum-oriented metrics in there, which kind of makes sense. So again, the impact of having a good quality normalized earnings per share figure is very real. Our research and our data shows it time and time again. You know, I just want to stress that importance to all of you in the audience today. So I'm going to go back to my slides for just a second here. So Deb, you touched on this earlier, or we talked about it earlier, is the idea of earnings surprise. And earnings surprise is one of those metrics. First of all, earnings surprise is, the definition is basically what is the consensus, what is the difference between what the company reports and what the consensus estimate is from the street on earnings just prior to the company reporting. And if the company beats expectations, often that drives short-term movement in the stock price. And of course, if it misses expectations, very often you'll see that it drives negative stock price movement over the short term. So this pattern or this reaction in stock price is very prevalent in Canada because we are a fairly cyclical market. And what it does is reiterates the importance of having a good, clean, normalized earnings per share on a timely basis. Because if you don't have it's like you're working with a moving target. If you don't know what the true earnings per share of a company is, you're not going to know how much they beat or miss expectations by. And having that quickly allows you as an investor to take advantage of that short-term market movement if that's your style. The second part of it is that the impact of that surprise it actually diminishes over time, because as more and more people understand that, okay, well, they beat earnings by 5%, I'm going to buy some more stock. The stock price is now higher by whatever it is. That excludes you from taking advantage of that same price, that same mispricing. So that impact diminishes over time, and it can also vary depending on the volatility of earnings of that same company. So for example, if a company like Royal Bank, which historically has had very consistent earnings, being a large company that's well established and mature, if they beat earnings by, let's say, 3%, that may have a larger impact than, let's say, a small cap mining company that historically has, very volatile earnings. If they beat or miss expectations by 10%, that impact might be less, right? So it not only has to do with timing, but also has to do with the historical volatility of the company that you're looking at. And of course, backing all this is the quality of the information that the earnings that you're getting. So what I thought I'd do is just share very quickly an example of how that might impact the strategy. So this was a reasonable strategy. You can get an understanding of how these different factors interplay with each other. And I got a 9.9% return annualized over time. So what I thought I'd do is to show you the impact of earnings surprise is I'd added an additional rule into my strategy. So in addition to everything I just showed you earlier, which remains the same, I also said that I will only consider buying companies that have beat their quarterly earnings expectations or have a positive earnings surprise. And I would sell any company that missed earnings by more than 5%.
All
now,
right, Ian, are you thinking of sharing something right now?
Oh, did I miss? Oh, let me, sorry.
No worries.
Thank you. Sorry about that, guys. Yeah, so my apologies. Let me go back to what I was saying before. So I had this this strategy that we were looking at earlier with the combination of fundamental metrics. And what I thought I'd do is just layer on an additional factor, which is earnings surprise. So in addition to what I had before, what I'm saying is I'm buying companies with a positive earnings surprise, and I'm selling companies with that have missed earnings by more than 5%. Now, what's unique about this is that I just want to mention our earnings surprise figure has two decay factors. The first is, like I said, based on time. So for every day that passes after the company reports, our earnings surprise figure reduces. So if if XYZ stock surprised earnings by 10% on day one, that figure would show as 10%. On day two, it might show as 8%. On day three, it might show as 6%. And then a day before the next quarterly earnings report, that figure would be 0%. What we're trying to do there is account for the again, the pricing in of the market. The second decay factor we have is around the consistency of earnings. So a company with very consistent earnings, like an RBC, for example, if they surprise by whatever percentage, we may actually gross that up. Whereas if a small cap mining company surprises, we may actually discount that surprise over time. So there's a bit of proprietary nature in our earnings surprise figure. So the result of that, if I ran the same test again, applying that earnings surprise figure over time, is of course a slightly better annualized return and slightly higher turnover, because earnings surprise tends to be very short term, kind of momentum driven. So again, very real impacts, and again, I can't stress enough the importance of having accurate earnings to drive this type of an investment approach. Let me go back to my slides here. Yeah, so that's I went pretty fast and furious there. So we went through a lot over the last 50 minutes or so. So I appreciate everyone's attention if you're still tuned in. So we talked about a few things. We talked about what's reported today and why it's not efficient. And essentially is that there are a number of there's a number of adjustments that are not necessarily standard that companies are applying to their earnings per share. And it often is not reflective of the true economic nature of that company's earnings. There are a number of common adjustments that affect earnings per share in Canada, things like restructuring charges, gain and loss from disposal of assets, litigation charges, things of that nature. Pretty much every fundamental metric that investors care about tend to be driven off of earnings per share. We talked about a bunch of them earlier, and we also showed you what those look like in action through various back tests. So that being said, I wanted to open it up if there are any questions from the audience. Happy to take those now, or Deb, if you have questions for me, happy to chat with you as well.
Sure. So this platform that you showed, this is commercially available to financial planners?
It's typically available to investment advisors and institutional portfolio managers. But it's one of many platforms that Morningstar has. I use this as a kind of a vehicle to demonstrate the quality of earnings, but certainly that data is available through a number of different Morningstar platforms.
Right, and it is a combination of streaming data plus analyst adjusted data. Is it depending on the module, I guess, that you would be
yeah, I would say Morningstar as a whole houses both real-time and fundamental data on stocks. The platform I was showing primarily focuses on fundamental data.
Right. So I understand that logically, these adjustments that come through may come through at any time for companies as well, correct? Not necessarily just looking at their end of quarter or annual reports. They could come in at any time, for instance, in a merger or acquisition restructuring. So that's kind of a separate stream of data altogether that comes in and is streamed through, or
no, so
as raw data, or how does that?
So our analysts will
Yeah,
account for that. So what we're doing is also scraping through press releases. So we have a feed of all the press releases coming through daily. And if we find that there's going to be a major adjustment to, any of the financials, we will go ahead and make those adjustments in our data as well.
Got it. Okay.
Mm-hmm.
So very interesting.
Go ahead. I'm curious about how long it took to get the correct algorithm and like all this kind of stuff set up. Because I imagine did you start from like square zero with just you're taking in data and trying to figure out what to do and just fiddling around?
Yeah, there was a yeah. So this goes into a little bit of the history of one of the companies that Morningstar has purchased. That was CPMS, or the one that we bought in 2009. So as I know from the history, it develops over time. And back in 1985, there were only call it 300 companies to deal with in Canada, right? So there's a far smaller, or much more finite set of information. And you're right, absolutely, Nick. So what happens is over time you build up this playbook of adjustment that you look at commonly, and that gets better year over year as our analysts get more. Our veteran analysts have been with CPMS or Morningstar for well over 20 years now, so there's definitely some experience there. But yeah, there's a playbook that develops over time, and as you see new situations happen, you build on that playbook. And in fact, that same team that drove that playbook is now spearheading Morningstar's global equity data methodology. So we're trying to, as best as we can, do the same type of normalization that we're doing in Canada for other countries as well.
Right. So, on your platform there, I saw lots of numbers, but I'm not sure that I saw the, assumptions behind those numbers for the adjustments or the normalizations. And I assume that, there's a plethora of notes there somewhere that, or metadata in our speak to document and to explain, the rationale behind some of the normalizations.
Yeah, absolutely. We try to be specific. We're not going to go to the detail of Shopify sold this asset, but we try to generalize them in categories as in metadata as you in your language. So you can see here that this is for RBC. They reported 276. We adjusted downwards by 1 cent on a disposal of asset. There was 6 cents of stock-based compensation, and it'll vary. So yeah, we try to capture it in a standardized way as well. So here's mark-to-market of financial instruments, like I talked about earlier. So write-offs of debt charges, that kind of a thing.
Right. But of course, how you actually did it is your proprietary stuff. So that's what you.
Yeah, exactly. And as we typically try to be pretty transparent. So if in the case that a portfolio manager or front office staff is asking, well, how come your number looks different than what I think it is? We typically put them directly in touch with an analyst, which will have their backup or their justification for it.
Sure. So that's talking to the financial analyst, but what about talking to the company that you're actually doing the adjustment on? Because of course, whatever you say will have some opinions back in RBC or Shopify.
We typically don't have. We typically try to keep an arm's length. It's going to be our interpretation of their financial statements, and they're usually pretty black and white. It's just the way that they report them is often not as useful as we'd like it to be. So, but we don't. In the case of adjusting earnings, I don't think we typically don't deal directly with the issuer.
Well, that sounds good. That sounds like good news.
Mm-hmm. Yeah, I imagine directly communicating with the people that you might be advocating to buy stocks on could be some sort of conflict.
Mm-hmm. Absolutely.
Well, I mean, or maybe they don't like the adjustment that you've done and have some opinion on it, and yeah, that could be an interesting conversation as well. But keeping an arm's length on all of that sounds like a great corporate decision.
And I should say that we do. It's very. I mean, this is our data operations, right? So we do have equity analysts as well at Morningstar that would, I guess, would be synonymous to a bank street analysts. Of course, we're not tied to an investment bank, so there's less of a bias there, in my opinion. And their approach is a lot different. They are in company calls, really playing the role of a sell side analyst for all intents and purposes. But that's a very different portion of Morningstar's capability. This is what I've talked about today is primarily the adjustment of data.
I have another question. You were talking about cycles of data to kind of figure out, what makes sense to buy and stuff like that, or sell, I imagine. How often would you go back and adjust historical information that you're basing decisions off of? Or if it's historically based, because I know that part of the thing was garbage in, garbage out. So in the future, if more information comes up on some company's earnings or something like that, do you make sure to double check and go back and change all that data?
No, so it's the opposite, Nick. So we call this database a point-in-time database, and the reason that backtest I showed you is realistic is because we are on purpose, we are not going back and adjusting something that's been restated. So for example, here are the list. I actually go to this one here. I'll go to the the quote unquote strategy that I built. Here are the stocks that meet my requirements today. But if I were to go back to, say, I don't know, let's call it April 2001. These are the companies that would have qualified at that point in time. So it's obviously, it's a very different list of stocks, and it's using the information that the company reported that we knew about at that point in time. And the reason that backtest works is because we're not adjusting that data. That's not to say that we don't adjust it for the current information that we display, that you would base your decisions on, but the robustness of a backtest engine is highly dependent on that data being untouched and not adjusted historically.
Okay, interesting. Thank you.
Right, that makes sense because you can then tie the point in time to the market movements at that time.
That's right. Yeah, we have a it's tied to the stock price at that point in time as well. So if I can pull up this guy here.
Thank you very much, Ian. This was a fascinating talk to peer into the guts of what happens in the back room to the market data that we may have not had any exposure to before, and to understand what financial service providers are actually up to when they give us advice. So thank you so much. And
my pleasure. Thanks for having me.
Tune in next month for our webinar next month. Thanks so much, everyone, and have a great day. Bye for now.